Hey everyone, gearing up for your company law exam? You already know that some sections are just, well, they're everything. Today, we're going to tackle one of the big ones, Section 128, all about the accounts of companies. Let's get right into it.
Okay, picture this. You're working as an accountant. You spot a small data entry error from last week, a simple typo. So you do the honest thing. You go in, you correct it, and now the books are perfect. Seems like a simple fix, right? But what if I told you that simple, well-intentioned edit could actually put you in a world of trouble and non-compliance?
Sounds a bit extreme for just fixing a mistake, doesn't it? Well, that's exactly why this section is so critical. We're going to break down Section 128 and all its related rules piece by piece so you can nail any question that comes your way.
First up, the absolute non-negotiables. Section 128 lays down 3 foundational principles for company accounting. Seriously, think of these as the constitution for your books of account. You just can't ignore them.
So, what are these 3 golden rules? 1. The books have to give a true and fair view. That means they're accurate, complete, and not misleading. 2. They must be kept on an accrual basis. We record things when they happen, not just when cash moves. And 3, they have to follow the double entry system. You know, our good old debits and credits. These are not suggestions, guys. They are mandatory.
All right, now for a part where so many marks are lost in the exam, definitions. In company law, words have super specific meanings. Confusing books of account with book and paper is a classic trap. Let's make sure you don't fall for it. First, books of account, as per Section 2.2.13. This is your core set of financial records. We're talking about all money received and spent, all sales and purchases, all assets and liabilities, and for some companies, specific cost records. It's the heart of your financial story.
Now let's look at book and paper. This term from Section 212 is way broader. It's like an umbrella term. It includes everything in books of account, plus things like deeds, vouchers, company minutes, and all sorts of official registers. So remember this for your MCQs. All books of account are book and paper, but not all book and paper are books of account. It's a classic ICAI twist.
Next up, financial statement. What's actually in it? Well, Section 240 gives us a very clear 5-part list. You've got the balance sheet, the P&L account, the cash flow statement, the statement of changes in equity, and of course, any explanatory notes that go with them.
But wait, there's a key exception here, especially regarding the cash flow statement. While most companies have to prepare one, the law carves out an exemption for a few specific types: one-person companies, small companies, dormant companies, and certain private startups. This is prime material for case studies, so definitely remember these exemptions.
And what about the financial year? Section 241 keeps it simple. It's the period ending on March 31st every single year. There is one little wrinkle, though. If a company gets incorporated on or after January 1st, its very first financial year will end on March 31st of the next year. So that first year can actually be longer than 12 months.
Now for a really important exception. What happens if an Indian company is a subsidiary of a foreign company that uses, say, a calendar year? Well, for easier consolidation, they can apply to follow a different financial year. And here's the exam twist. Who do they apply to? The central government. Not the tribunal, not the ROC, the central government. This is a recent change, so you can bet it's on ICAI's radar.
Okay, so we know what to prepare and for which period. But where does all this paperwork actually live? The law is very, very specific about the location. Let's break it down. The default rule is super straightforward. Section 128.1 says every company has to keep its books of account and other records right there at its registered office. Simple as that. But you guessed it, there's an exception. The board of directors can pass a resolution to keep the books somewhere else. But, and this is a big but, that somewhere else has to be in India. You can't just decide to keep your main accounting records in another country.
Now, if the board does decide to move the books, they trigger a compliance requirement. The company absolutely must file Form AOC-5 with the Registrar of Companies, and they have to do it within 7 days of making that decision. Remember the form, AOC-5. Remember the timeline, 7 days. This is pure exam gold.
All right, everyone, I need you to lean in for this next part. This is the most critical, most tested part of this section right now, maintaining books in electronic form. This is a massive exam hotspot, so let's focus. So this brings us right back to our opening question. Starting from the financial year 2023-24, if you use accounting software, it must have an audit trail feature. What does that mean? It means the software has to record a log of every single transaction and create an edit log showing every change that was made, who made it, and when. And here's the killer point. That audit trail feature cannot be disabled. So that little fix we talked about, it has to be captured in that unchangeable log. This is a massive step for corporate governance designed to stop backdated entries and create a transparent financial history.
Now, let's talk data storage. Your electronic books must be accessible in India at all times. So what if your main server is in, say, the US? The rule is crystal clear. You must maintain a daily backup on servers that are physically located in India. Not weekly, not monthly, daily. This is a huge compliance point.
And there's one more thing. If you're using a cloud service provider, think Amazon Web Services, Microsoft Azure, whatever, you have to tell the registrar about it. You need to provide the provider's name, IP address, and location. And you have to do this every year when you file your financial statements.
We've covered the rules for the main office, but what about companies that have branches, maybe across India or even abroad? How do we bring all that information together?
The rule for branches is actually pretty practical. The branch office doesn't have to courier every single voucher to the head office. That would be a nightmare. Instead, it has to prepare and send proper summarized returns on a periodic basis. This way, the head office can incorporate the branch's data and maintain that consolidated, true and fair view for the entire company without getting drowned in paperwork. So let's circle all the way back to that first question. That simple accounting edit, was it compliant? Well, now you know the answer. If the software logged the change in an unalterable audit trail showing the date and details, then yes, it's perfectly fine. But if it didn't, the company is in violation. See how a tiny detail suddenly becomes a major compliance issue?
And this isn't just theory for an exam. Getting any part of Section 128 wrong can lead to a hefty fine, from 50,000 all the way up to 5 lakh rupees for the company and its officers. We're tackling Sections 130, 131, and 132. Now, these three are not only linked together, but they are an absolute favorite for ICAI exam setters. So stick with me, and I promise you'll walk away ready to handle any question they throw at you on this.
So let's start with a classic exam problem. Imagine this. A company has done everything perfectly. Accounts are prepared, they're audited, they've been adopted at the annual general meeting, and filed with the ROC. Everything's done. But then, oops, they find a mistake. So can they just go back and change it? The short answer is yes, but it is not that simple. There's a whole process you've got to follow, and that's exactly what we're going to navigate together.
Okay, I need you to really focus now, because this right here is the #1 trap where students lose easy, crucial marks. They mix up the words reopening and revision. They use them like they're the same thing. They are absolutely not. One is forced upon the company, the other is voluntary. Get this difference straight in your head, and you're already miles ahead of everyone else.
So let's break it down. You've got two completely different paths for fixing past accounts. On one side, you have Section 130, reopening. This is forced on a company, usually because of something really serious like fraud. Then, on the other side, you have Section 131, revision. This is where the directors themselves decide to make a change, usually because they realize they didn't comply with the law. And look at the time frames. 8 years for reopening versus just 3 for revision. Huge difference.
So first up, Section 130. I like to call this the forced fix. Why? Because the company has absolutely zero say in the matter. Some outside authority has found a major problem, and now a court or tribunal is ordering them to go back and fix their books. They have no choice. So, who can kickstart this whole process? Now, this is a super important point. Notice who is not on this list: the company itself. The company cannot apply to reopen its own accounts under this section. The request has to come from big, powerful bodies like the central government, the income tax department, or SEBI. That should immediately tell you we're dealing with a very serious situation here.
And look, we're not talking about a tiny calculation error. The grounds for this are huge. The application has to claim either that there was outright fraud in the accounts or that the company was so badly mismanaged that you just can't trust the financial statements at all. You have to remember, Section 130 is like the nuclear option. It's saved for when there's a major problem with integrity.
So how does this actually happen? Well, it's a formal legal process. An authority applies to the tribunal, but the tribunal doesn't just make a decision on the spot. It issues a notice to everyone involved, giving the company a chance to tell its side of the story. It's only after hearing everybody out that the tribunal might order the accounts to be reopened and redone. And once those new accounts are finalized, that's it. They are final. Okay, get your highlighters out because this number is a classic exam question. How far back can the tribunal order a reopening? The standard answer is a maximum of 8 financial years. But, and you know how ICAI loves to test this, there's an exception. If the central government had already told the company to keep its books for, say, 10 years, then the reopening can go back for that full 10-year period. Don't forget that little detail.
All right, so that was the heavy-duty forced fix. Now, let's completely flip the script and look at Section 131. This is what I call the company's fix. It's the voluntary path, where the company itself realizes something is wrong and decides to correct its past accounts.
This slide right here is your golden ticket for this entire topic. Seriously, every single row is a potential exam question. Let's look at the key differences. Initiator, court order versus the director's decision. Nature, compulsory versus voluntary. Grounds, serious fraud versus simple non-compliance with the law. Time limit, 8 years versus 3. And here's a detail that often gets missed. Under Section 131, a company can only do this once in a financial year. You absolutely have to know this table inside and out.
This little diagram basically sums up the flow for Section 131. It all starts with the company's directors. They spot an issue, maybe their past financial statements or the board's report didn't quite follow the rules in Sections 129 or 134. But here's the key thing. They can't just fix it themselves. They first have to go to the tribunal and get permission.
And when the company goes to the tribunal, they can't just show up empty-handed. Under Rule 77, they have to lay all their cards on the table. The tribunal wants to know exactly what year we're talking about, who the key people were, who the auditors were, and most importantly, the specific reasons for the revision. This is definitely not a rubber stamp process. The tribunal needs full transparency before they'll say yes.
So let's quickly walk through the whole process. First, the board says, yes, we need to revise. Then they apply to the NCLT. The NCLT, just like in Section 130, gives a notice to the government and tax authorities to see if they have any objections. If the tribunal gives the green light, there's a second, really important approval needed. The company has to get its own members to approve the changes in a general meeting. It's only after this dual approval from both the tribunal and the members that the revised accounts can finally be filed with the ROC.
Now, this is a really crucial point. Section 131 is a tool for correction, not for creative rewriting of history. A company can't use this as an excuse to go back and make their past performance look better. No way. The scope is very narrow. You can only make changes to fix the specific non-compliance with the law and any direct knock-on effects of that fix. That's it. Nothing more.
Okay, so we've covered the 2 ways to fix past accounts. But that begs the question, who sets all these accounting and auditing rules in the first place? And who makes sure everyone is actually following them? Well, that brings us to the final piece of our puzzle, the big watchdog, NFRA, which was set up under Section 132.
So what in the world is NFRA? Well, to put it simply, it's the high-level authority created by the central government to basically be the big boss of financial reporting quality in the country. Its main job is to set the rules for accounting and auditing and then make sure people actually follow them.
So does NFRA police every single company in India? Absolutely not. Its power, as defined in Rule 3, is focused like a laser on what we call public interest entities. So think about listed companies, really big public companies, and important sectors like banking and insurance. The logic here is pretty simple. NFR focuses on the big players because the quality of their financial reporting has the biggest impact on all of us.
And the reason NFRA has so much credibility is because of who's on it. It's led by a chairperson who has to be an expert in accounting, audit, finance, or law. And they're supported by up to 15 other members. So you've basically got this powerhouse of expertise, which allows them to effectively regulate the whole financial system.
So we know who NFRA is, but what does it actually do? What kind of powers does it have? Let's break down its key functions to see what its impact is in the real world. It really boils down to 4 main jobs. First, it recommends the accounting and auditing standards. Second, and this is a big one, it monitors and enforces compliance with those standards. Third, it keeps an eye on the quality of work that auditors are doing. And fourth, it collaborates with other regulators both here in India and around the world.
And what's really interesting is how FNDSRA can look at both sides of the coin. To check on accounting standards, they go after the company. They can review their financial statements, they can summon their officers. But to check on auditing standards, they can go straight to the source, the auditors themselves. They can demand to see their working papers and even check out their internal quality control systems. This gives them an amazing 360-degree view of what's going on.
An NFRA isn't just about punishment, it's also about proactively making things better. They can review an auditor's work and then literally direct them to take steps to improve their quality. The auditor then has to report back on what they've done. NFRA monitors the whole thing, and if needed, they can even refer the case to the Quality Review Board. It's a full-circle system designed to constantly improve quality.
Okay, let's kick things off with a scenario that smells like an ICI exam question from a mile away. Picture this. A company's board wants to be super proactive. They decide to send out the annual accounts to shareholders before the AGM. Nice, right? But here's the catch. The audit isn't done yet, so they're circulating the unaudited accounts. So what's the verdict? Is this just a friendly heads up, or is it a massive, massive blunder? You guessed it. This is a classic ICI trap, and we are going to take it apart right now.
Okay, first up, financial statements. This is the foundation, you guys. Everything, and I mean everything we talk about today, builds on what we're about to cover right here.
So let's get back to that first question. Can a company circulate unaudited accounts? The answer is a huge, emphatic no. And listen, this is a classic spot where students lose marks. The law is super clear on this. Section 129, subsection 2, says the board shall lay the financial statements before the AGM. Then, Section 134, subsection 7 doubles down, saying a signed copy has to be circulated. Bottom line, if it's not signed, and more importantly, if it's not audited, it has no business being at an AGM. Period.
Now, when we say financial statements, what are we actually talking about? Because it's not just the P&L and balance sheet. Nope. Under the Companies Act, it's the whole shebang. You got your balance sheet, your P&L, your cash flow, and the statement of changes in equity. But wait, there's more. You also have to include the notes to accounts, the auditor's report, and the board's report. It's a complete package deal. Anything less just isn't the full picture.
And you can't just, whip these statements up. They have to be built on 5 solid, non-negotiable principles. The big one, the main goal of this whole exercise, is to give a true and fair view. That's everything. And to get there, you've got to comply with accounting standards under Section 133, use the accrual basis, use the double entry system, and, this is a big one, stick to the format laid out in Schedule 3. No ifs, ands, or buts about these 5.
Okay, so we've got our numbers straight. Now let's move on to the story behind those numbers. That's the board's report. If you think of the financials as the what happened, the board's report is the why it happened and how we feel about it. It's the company's official narrative for the year.
So what's actually in this thing? Well, it's a pretty long list, so let's take it in chunks. First, you've got the high-level stuff, a report on the state of the company's affairs, what they're planning to stick in reserves, and the dividend they're proposing. Oh, and this one is super important. They have to talk about any major changes or commitments that happened after the financial year ended. And of course, you've got to have the details of any loans, guarantees, or investments made under Section 186.
Okay, lean in for this one. This is a huge exam tip. I'm serious. Pay attention. When a company deals with related parties, under Section 188, they have to disclose the particulars. But not just anywhere. It has to be in a specific form. And that form is Form AOC-2. Write it down, highlight it, tattoo it on your arm, whatever you have to do. ICAI loves, and I mean loves, to ask about form numbers and MCQs. RPTs, Form AOC-2. Got it?
Right, and the board's report isn't just for happy news and sunshine. It has to get real about the tough stuff too. If the auditor leaves a nasty note, a qualification or an adverse remark, the board has to give a full explanation. They can't just ignore it. They also have to fess up about any deposits that didn't follow the rules, mention any big court orders that might affect their going concern, and, this is critical, comment on how good their internal financial controls are. And lastly, a little note confirming if cost records under Section 148 have been maintained.
Now, buried inside the board's report is the super important mandatory section called the Director's Responsibility Statement. This is where the directors basically put their necks on the line. They're personally stating, yep, we followed the accounting standards, yep, our policies were sound and prudent, yep, we took care of the assets, and yep, we prepared the accounts on a going concern basis. And for listed companies, there's an extra one. They have to vouch for their internal financial controls. Every single one of these points is a potential exam question, so know them well.
So, does every single company have to write this epic novel of a report? Well, no. The law gives a little break to one-person companies, OPCs. Look at this side by side. The full report is this huge, long list of things, RPTs, the whole director's responsibility statement. It's a lot. But the abridged report for an OPC, it's way simpler. It just needs a financial summary, explanations for the auditor's comments, and a few other key points. The big thing to remember for your exam is that the compliance headache is way smaller for an OPC. It's a classic comparison question.
Okay, next up, Section 3. We're shifting gears a little bit, from just the numbers to a company's duty to society. We are talking about CSR, corporate social responsibility. And for some companies, this is an absolute non-negotiable. And for you, it's a super important, heavily tested exam topic.
Listen up, because the most important thing to know about CSR isn't what counts, it's what doesn't count. This negative list is an absolute goldmine for ICAI exam traps. So, something you do in your normal course of business? Nope, not CSR. Something that only benefits your own employees and their families? Not CSR. Sponsoring an event just to get your logo everywhere? That's marketing, not CSR. Paying your taxes or other legal duties? Come on, definitely not CSR. And contributing to a political party? Absolutely forbidden. You have to memorize this list. It's how you'll dodge those trick questions.
Okay, so before the big external audit happens, companies need to have their own internal watchdog, right? Their own system of checks and balances. That brings us to our next stop, internal audit. Think of it as the company's first line of defense.
So who can actually do this job? Well, it can be a chartered accountant, a cost accountant, or really any other professional the board thinks is up to the task. But here's the juicy detail that ICAI loves to use for tricky MCQs. Ready? The CA or CMA does not have to be a practicing one. And the internal auditor can be an employee, or it can be an outside firm. This flexibility is exactly what ICAI uses to try and trip you up, so remember it.
Okay, so who exactly needs to have an internal audit? This table makes it pretty simple. First, if a company is listed, easy peasy. It's always applicable. Always. For an unlisted public company, you got to check 4 numbers from the last financial year. If you cross any one of these limits, you need an internal audit. The limits are paid-up capital of 50 crores, turnover of 200 crores, loans over 100 crores, or deposits of 25 crores. For a private company, it's a bit simpler. You just look at turnover of 200 crores or loans over 100 crores. The magic word here for all of them is or. Hit just one and you're in.
All right, we've talked about how companies prepare their own accounts and check their own work. Now let's talk about the super regulator, the big boss that watches over everyone. Let's talk about NFRA, the National Financial Reporting Authority.
So what is NFRA? Just think of it as the ultimate watchdog. It keeps an eye on auditors, it keeps an eye on companies. Basically, it oversees the entire accounting and auditing world. And it's independent. Its whole job is to make sure reporting quality is high. Get this. Even when ICA comes up with a new accounting standard, it has to go to NFRA for review before the government makes it official. That's some serious power. So who's on this board? It's a real who's who. You've got people from the MCA, the CAG, the RBI, and SEB. The ICAI president is there too, along with the heads of the accounting and auditing standards boards. It really shows you how connected NFRA is. And here's a key rule you need to remember. Any full-time members have to take a 2-year break, a cooling-off period after they leave, where they can't join any audit firm. That's super important for making sure they stay independent.
And don't think NFRA is just some advisory committee. No way. This body has real teeth. It literally has the powers of a civil court. What does that mean? It means it can issue commissions to investigate things. To put it simply, NFRA can legally force people to show up and answer questions, and it can demand to see any documents it wants. When NFRA comes knocking, you have to answer.
Okay, we've made it to the last step in the journey. The accounts are ready, the reports are written, the auditors have signed off. Now what? Well, now it's time to get this information out there, to the shareholders and to the public.
So for listed companies, transparency is key, and that means using the internet. The law is clear. They have to put their financial statements up on their website. That includes their own statements and the consolidated ones for the whole group. But, and here's the crucial point that so many people miss, they also have to upload the separate audited accounts for each and every one of their subsidiaries. This is a huge deal for transparency, and it's a detail that examiners love to ask about.